The shocking truth: 88% of SIP investors stop investing. In the world of personal finance and investment, systematic investment plans have long been celebrated as the ideal vehicle for building long-term wealth. These disciplined investment tools allow investors to commit small amounts regularly, harnessing the power of compounding and market averaging. Yet beneath this rosy picture lies a startling reality: a staggering 88% of SIP investors abandon their investments prematurely. This alarming statistic reveals a significant disconnect between investment theory and real-world behavior, posing crucial questions about investor psychology, financial literacy, and industry practices. This presentation examines why so many investors halt their SIP journey midway, the consequences of these decisions, and actionable strategies to ensure investment success. Understanding systematic investment plans. Definition: a disciplined approach that allows investors to invest fixed amounts at regular intervals in mutual funds, regardless of market conditions. Key benefits: rupee cost averaging minimizes timing risk, while compounding accelerates wealth creation over time. Automation provides convenience for busy investors. Target audience: primarily retail investors seeking long-term financial goals like retirement, education funding, or home purchases. Growth trajectory: SIP inflows in India reached record highs of $1.8 billion monthly in 2023, demonstrating their growing popularity. SIPs have revolutionized the investment landscape by democratizing access to financial markets. Their structure encourages financial discipline by removing the emotional component from investment decisions. Rather than attempting to time the market, investors commit to regular contributions regardless of market conditions. This set-it-and-forget-it approach has made SIPs particularly attractive to first-time investors and those without extensive financial knowledge. The accessibility of starting with amounts as low as 500 rupees monthly has further broadened their appeal across economic demographics. The 88% attrition rate, a deep dive. According to a comprehensive CRISIL report analyzing 5-year SIP data across major fund houses, an alarming 88% of investors stop or redeem their investments prematurely. This attrition rate far exceeds comparable long-term investment vehicles, suggesting a systemic problem within the SIP ecosystem. The most critical drop-off period occurs within the first 3 years, with nearly 72% of investors abandoning their SIPs during this crucial early stage. This premature exit typically happens just before the powerful effects of compounding would begin to accelerate returns substantially. This mass exodus represents a significant loss in potential wealth creation for millions of investors who miss out on the very benefits that attracted them to SIPs in the first place. Why are investors abandoning SIPs? Market volatility. Significant market downturns trigger fear responses, causing investors to abandon their investment plans to prevent further losses. The March 2020 crash during COVID-19 saw record SIP redemptions. Financial emergencies. Unexpected expenses like medical emergencies or job loss force investors to tap into SIP investments prematurely. Personal finance surveys indicate that 76% of Indian households lack adequate emergency funds. Liquidity needs. Major life events such as education expenses, home purchases, or weddings create significant cash requirements, leading investors to liquidate their SIP holdings. Market volatility creates a particularly challenging psychological environment for investors. When markets experience sharp corrections, like the 35% drop during the March 2020 COVID crash, the paper losses can trigger strong emotional responses even among otherwise rational investors. These responses are amplified when investors lack financial buffers. According to a recent financial wellness survey, over 3/4 of Indian households don't maintain adequate emergency funds, making their SIP investments vulnerable to premature withdrawals during financial hardships. Why are investors abandoning SIPs? Financial literacy gap. Many investors lack understanding of market cycles, expected returns, and investment horizons. This knowledge gap leads to unrealistic expectations and panic selling during market corrections. Mis-selling practices. Financial advisors sometimes recommend aggressive equity funds to risk-averse investors or set unrealistic return expectations to secure commissions, leading to disappointment and early withdrawals. Underperforming funds. Investors frequently select funds based on recent performance rather than consistency, resulting in portfolios of previously hot but currently underperforming investments. Impatience. The instant gratification culture conflicts with the long-term nature of wealth building. Many investors expect quick returns and abandon SIPs when they don't see immediate growth. Financial literacy remains a significant challenge, with the 2022 SEBI survey revealing that only 27% of Indian investors understand basic investment concepts like compounding and inflation. This knowledge gap creates a disconnect between expectations and market realities, setting the stage for disappointment. The problem is compounded by industry practices that sometimes prioritize sales over suitability. Commission-based advisory models can incentivize recommending products with higher fees rather than those best suited to investor needs. Meanwhile, the proliferation of financial content on social media often promotes get-rich-quick narratives, creating unrealistic expectations about investment returns. The impact of premature SIP termination. Potential loss. Amount of 5,000 rupees monthly SIP could have grown to over 15 years at 12% returns. Lower returns. Average reduction in returns for investors who exit during market downturns. Missed growth. The approximate factor by which money grows in 15 years versus 5 years at 12%. The financial impact of prematurely terminating SIPs extends far beyond the immediate withdrawal amount. By exiting early, investors forfeit the powerful compounding phase that typically accelerates in later years. A 5,000 rupees monthly investment grows dramatically differently over 15 years compared to just 3 or 5 years. Behavioral finance research shows that retail investors who redeem during market downturns typically re-enter after recovery has begun, creating a damaging buy high, sell low pattern. This timing penalty alone can reduce lifetime returns by over a third compared to simply staying invested. Perhaps most significantly, these interrupted investment journeys create a cycle of financial disappointment that damages investor confidence and perpetuates the belief that equity investments are unreliable vehicles for wealth creation. Strategies to stay invested. Financial goals. Tie investments to specific life objectives. Education. Understand market cycles and investment principles. Strategic planning. Create an investment plan with clear timelines. Emergency fund. Build 3 to 6 months of expenses before investing. A goal-based investment approach fundamentally changes investor psychology. Rather than focusing solely on market movements, investors can measure progress against specific life objectives like retirement funding or education planning. This perspective makes it easier to withstand short-term volatility by maintaining focus on long-term objectives. Financial education plays a critical role in building investor resilience. Understanding concepts like market cycles, average returns, and the mathematics of compounding creates realistic expectations. Investors who recognize that volatility is an inherent part of equity markets are far less likely to panic during corrections. Diversification across asset classes provides both psychological comfort and practical protection. When portfolios include a mix of equity, debt, and sometimes alternative investments aligned with risk tolerance, the overall volatility decreases, making it easier to maintain investment discipline. Reversing the trend, a call to action. Start with education. Investors should commit to understanding basic investment principles before starting SIPs. Fund houses and advisors must prioritize education over immediate sales, creating informed investors who can withstand market cycles. Build strong foundations. Establish emergency funds before beginning investment journeys. Financial planners should guide clients to create 3 to 6 months of liquid savings, protecting long-term investments from unexpected withdrawals. Create accountability. Use regular portfolio reviews and financial mentors to maintain discipline. Technology platforms should incorporate behavioral nudges that discourage emotional decision-making during market volatility. Advocate for change. Demand industry reforms in advisory practices and fee structures. Regulators should strengthen disclosure requirements and create incentives for long-term investor success rather than just asset gathering. The 88% SIP attrition rate represents both a challenge and an opportunity. By addressing the root causes of premature withdrawals, the investment community can help millions achieve their financial goals while building a more sustainable industry. This requires commitment from all stakeholders in the investment ecosystem. Educational initiatives must move beyond simple product information to include foundational financial concepts and behavioral coaching. Meanwhile, technological solutions can provide timely interventions during market volatility, helping investors resist emotional decision-making. The ultimate goal must be to transform SIPs from products that are simply sold to genuine wealth creation tools that investors understand, trust, and maintain through all market conditions. Only then can we reverse the shocking 88% attrition rate and unlock the true potential of systematic investing.